Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So today we're unpacking the latest from TSMC, their recent earnings call.
That's right.
And this is more than just, looking at spreadsheets. It really gives us a peek into where technology is heading.
Absolutely. The whole semiconductor world, really, it underpins so much, and it's key for anyone watching investments in this space.
Definitely. And one thing that jumped out right away was how they dealt with that earthquake back in January.
Oh, yeah. That was significant.
The fact they got things back online so quickly, it says a lot about their operational muscle.
It really does. It's not just about the fancy tech. It's being resilient when things, go sideways.
Exactly. So beyond that, the call really highlighted some big themes. Massive AI demand, for one.
Huge. Can't overstate that.
And then these really ambitious global expansion plans. We're talking US, Japan, Europe.
Big moves. Spreading out the manufacturing footprint.
Plus, they're just relentlessly pushing the tech itself. 3 nanometer, 5 nanometer are big now, but they're already deep into 2 nanometer, even planning for A16.
Always looking ahead. And all of this naturally has major financial ripples we need to get into.
Right, so let's start with Q1 financials. There was a bit of a sequential dip in revenue, NT dollar and US dollar terms.
Yeah, which isn't totally surprising. You often see that slowdown in smartphones after the holidays. It's seasonal.
True, but what cushioned that dip?
Well, that's the AI story again. That demand is just so strong, it offsets some of that smartphone seasonality. Really shows you how AI is becoming a central pillar.
Good point. And what about profitability? Gross margin was also down slightly.
It was. Part of that was definitely the earthquake impact, but it's also the initial costs starting to hit from the overseas fabs.
The dilution effect.
Exactly. Getting Kumamoto in Japan up and running, those costs are starting to factor in, sort of like growing pains for going global.
Makes sense. And operating margin followed suit.
Yep, also saw a decrease there. Bottom line, EPS was TWD 13.94, and ROE stayed pretty strong at 32.7%.
Still healthy numbers then.
Oh, absolutely. But the slight dips do tell that story of, heavy investment for the future.
Okay, let's break down the revenue by the tech itself. 3 nanometer was already, 22%?
Yeah, 22% in Q1, add in 5 nanometer at 36%, and 7 nanometer at 15%.
So doing the math, 7 nanometer and below, the really advanced stuff, is making
A massive 73%. It's the vast majority of their business now. Shows you where the action is.
And TSMC is leading that charge.
No question. They dominate that leading edge.
And if we look at the platforms driving it, HPC, high-performance computing, saw growth.
It did, up 7% from the previous quarter.
Yeah.
And now it's 59% of their total revenue. Just huge.
59%.
Yeah, and that's where a lot of that AI demand lives, the
Yeah.
GPUs, the accelerators for data centers.
Right, right. Meanwhile, smartphones took that seasonal hit.
Big time, down 22%. Pretty typical for Q1, like we said. IoT was also down a bit, 9%.
But automotive and DCE, the consumer electronics stuff, they were up.
They were. Auto up 14%, DCE up 8%. Smaller pieces of the pie overall, but still positive signs there.
Okay, shifting gears slightly. Balance sheet health. Cash position looks solid.
Very solid. Around $81 billion in cash and marketable securities.
Yeah.
They did see current liabilities tick up, mostly accrued taxes.
And anything on receivables or inventory?
Slight increase in how long it takes to get paid, and inventory days went up a bit too. They said that's mainly tied to ramping up those new overseas fabs, just part of the process.
Got it. And cash flow. How much are they generating and reinvesting?
Generated a very healthy TWD $626 billion from operations in Q1. Put TWD $331 billion into CapEx, that's over $10 billion US,
Wow.
and paid out TWD $104 billion in dividends. They also issued some bonds. Gives you a sense of the sheer scale.
It really does. Okay, so that's Q1. What's the outlook for Q2?
They're guiding for revenue between $28.4 and $29.2 billion.
Okay.
The midpoint there would be, let's see, about a 13% jump sequentially compared to last year. A very strong 38% year-over-year growth.
That's some serious acceleration. Profitability guidance.
Gross margin expected between 57% and 59%. Operating margin between 47% and 49%. Still very robust margins, even with those expansion costs starting to bite.
Impressive.
One thing to note for Q2, though, is the tax rate. It's expected to jump to around 20%.
Why is that?
It's an accounting thing related to undistributed retained earnings tax. But they expect it to drop back down to the 14–15% range for the second half of the year.
Ah, so a temporary thing.
Exactly. Should average out to 16–17% for the full year.
Okay. Let's dive back into that global expansion and the margin impact. You mentioned Kumamoto starting to dilute things.
Yeah, and they expect Arizona to start contributing to that dilution in Q2 as well.
And for the full year?
The forecast right now is that these overseas fabs will probably shave off about 2% to 3% from their overall gross margin in 2025.
2 to 3%, that's noticeable.
It is. And looking out further, especially with that huge $100 billion plan for Arizona,
Yeah.
they expect that margin impact to actually widen over the next 5 years,
Widen to how much?
starting in that 2–3% range annually, but maybe increasing towards 3–4% in later years of that 5-year window. It's a significant cost of diversification.
But they still seem confident about hitting their long-term margin target of 53% plus.
Very confident. They keep pointing back to their core strengths,
Yeah.
leading tech and sheer scale. The argument is that even with higher costs overseas, their efficiency will keep them ahead.
That $100 billion in Arizona, that's not just for one factory, right?
No, it's a massive build-out.
Mm.
Multiple fabs, advanced packaging facilities, which are super important now, and even an R&D center.
A whole ecosystem, basically?
Exactly. Signals a really deep, long-term commitment to the U.S.
And how's the first Arizona fab doing?
Apparently, it's already in high-volume production and for process. And importantly, the yields are comparable to Taiwan.
That's huge news. A really good sign.
Definitely a positive proof point. And they're pushing ahead with the second Arizona fab, the 3-nanometer one, trying to speed it up because AI demand is so strong.
Adapting quickly. What about fabs 3 and 4?
Those are planned for N2 and the new A16 tech. Construction expected to start later this year, assuming permits come through.
And they're even thinking beyond that. Fabs 5 and 6.
Yeah, potentially. Depends on customer demand down the road. But they're laying the groundwork for a really substantial presence.
With packaging and R&D included, it completes the picture for advanced stuff like AI in the U.S.
That seems to be the goal. A self-contained, leading-edge cluster.
And they made a point about partnerships, right? They're doing this solo.
Explicitly. No joint ventures, no tech licensing for their advanced nodes in the U.S. It's all TSMC.
So the goal is about 30% of their most advanced capacity, 2 nanometers and beyond, in Arizona eventually.
That's the target they mentioned. A significant chunk, creating that independent U.S. hub.
While still growing elsewhere, too. Japan, Europe.
Yep. Kumamoto's specialty fab is running. Second fab plan there. Dresden in Germany is on track.
Yeah.
And crucially, they stressed continued heavy investment in Taiwan, too. New wafer fabs, packaging plants. Taiwan is still very much the core.
Okay, let's switch back to demand. Q1 saw that smartphone dip, but strong AI. What about Q2 demand?
Expecting strong growth in both 3-nanometer and 5-nanometer. Those are the real workhorses right now for advanced applications.
And the overall foundry market outlook for 2025?
They're still positive. Think AI is the main engine, plus maybe a mild recovery elsewhere. Their view seems to line up with analysts like IDC, predicting around 11% growth for the foundry sector overall.
What about tariffs? Any impact seen yet?
They said no. No significant changes in customer behavior due to tariff talks so far. So they're sticking with their full-year revenue growth forecast.
Which was?
Mid-20s% growth in U.S. dollar terms. Pretty robust.
And they doubled down on the AI accelerator forecast.
Reaffirmed it, expecting that revenue stream, GPUs, ASICs, HBM controllers to double this year, 2025.
To meet that, they need more packaging capacity, right? The Kawo stuff.
Exactly. They're working flat out to double Kawa's capacity this year. Demand is still way ahead of supply, apparently.
But getting better.
They think it'll be more balanced in 2026 as the new capacity really comes online.
And the long-term AI picture still looks bright.
Very bright, they believe. Driven by ongoing AI model improvements, they have a whole planning system focused on meeting this structural increase in demand.
They put a number on that, a growth rate for AI accelerators.
Yeah, they projected a KHR, compound annual growth rate, in the mid-40s% over the next 5 years, starting from 2024.
Mid-40 CAGR, that's just...
Wow.
It's massive growth.
Okay, let's talk tech roadmap. N2, the 2-nanometer node.
On track. Volume production scheduled for the second half of 2025.
And they expect more designs for N2 early on compared to N3 or N5.
That's what they said. More tape-outs expected in the first couple of years, driven by both smartphones and HPC. Seems there's a lot of interest.
What are the performance gains? N2 versus N3E. The numbers they gave were 10–15% faster speed at the same power, or 20–30% power saving in the same speed, plus over 15% more density. Standard Moore's Law stuff, but still impressive. And they're not stopping there. They announced N2P.
Right, an enhanced version. More improvements. When's that due?
Volume production planned for the second half of 2026, so a year after N2. Continuous improvement.
And then there's A16. What's special about that one?
A16 has this superpower rail feature, offers another jump over NDP, maybe 8–10% more speed or 15–20% less power, plus a bit more density.
What is it for?
They said it's particularly suited for some HPC products, things with really complex wiring and power needs, also targeting second half of 2026 for volume production.
So N2, N2P, A16,
Yeah.
that's their path to staying ahead.
That's the plan. They clearly believe this roadmap extends their technology leadership significantly.
Let's touch on geopolitics again, the tariff issue specifically. How did they frame it?
Basically, they acknowledged the discussions, but said, look, we've factored potential impacts into our forecast already.
And no customer changes yet.
None observed. Business as usual for now. They also stress they're a private company. They don't get involved in government negotiations.
What about subsidies, government incentives for building fabs?
Their stance seemed to be about fairness. If incentives are offered, they should be available to everyone, essentially. A level playing field.
Makes sense. And the U.S. expansion rationale, just to recap.
Two main things. Customer demand for geographic options and government support making it feasible.
Driving towards that goal of 30% of 2-nanometer capacity in Arizona.
Yep. And the R&D center there is key, supporting the fabs, improving tech, enabling more independent U.S. operations, maybe even some university collaborations.
Are they hitting any roadblocks? You mentioned speeding up Fab 2.
They did acknowledge challenges with finding enough skilled labor in Arizona. That's something they're actively working on as they ramp up these huge new facilities.
Yeah.
It's a known issue in the industry.
Okay. Last couple of points. Pricing and shareholder returns. Are they charging more for chips made overseas?
They didn't say explicitly yes, but they talked about continuously reflecting value in their pricing. That includes the value of geographic flexibility and the high capital costs.
So sounds like discussions are happening with customers.
They confirm that. Ongoing talks with major customers about pricing in the context of this global expansion, it's clearly part of the negotiation.
And shareholder returns. Still focused on dividends.
Yes, very clearly. Policy is sustainable, steadily increasing cash dividends. That's their preferred way. No plans for share buybacks.
Okay, so wrapping this up. Key takeaways from the call.
Well, AI demand is just a dominant force driving growth. The global expansion is real, significant, and comes with costs, but it's a strategic imperative for them.
And they're determined to stay at the absolute cutting edge of technology.
Absolutely. N2, A16, the whole pipeline.
It all feels very interconnected, doesn't it? The demand, the expansion, the tech leadership, the financial implications.
Definitely. It paints a picture of a company navigating a really complex global stage while pushing technological boundaries. Their resilience and strategic focus are quite remarkable.
It does leave you thinking, though. This big shift towards more geographically diverse chip manufacturing. What are the long-term implications of that? For supply chains, for global tech innovation, how does that reshape the landscape?
That's the big question, isn't it? Something to definitely keep watching as this vital industry continues to transform itself and, well, transform our world.
Indeed. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.